You have to treat it like a bill. I tell people that. You treat it like a bill. And you know what? It's a bill that's going to pay you later on.
Yeah.
And that's part of what you talk about all the time, paying yourself first. Paying yourself first. You have to pay yourself first. So that's what about, I think emergency funds and then consistent investing every 2 or 3 weeks and not trying to time everything. You're going to be thanking yourself that you did.
Welcome to this episode of the Business of Athletes podcast, where we cover the business of athletes from all angles. And on today's episode, we have a regular contributor, friend of the podcast, Braden Kopp. And so what we're going to do today, our past few videos, we've been giving you some shorter, quicker explanation videos on what is the stock market, what are index funds, ETFs, tools, and definitions. But this one, we want to kind of spend some time answering some questions about investing, some questions that I've seen on social media, some questions that I've had asked to me. And so, Braden, one, welcome. And two, we're just going to jump right in, man. How you feel about that?
Let's do it.
All right, bet. So I'm 26, you're 25, and a lot of our peers right now are just getting into the thick of their working careers. And a question that I'm seeing a lot and I'm hearing a lot is should I be investing right now? There's a lot of kind of angst about it because of where the market is, because of what's going on globally and even in our own markets.
Yeah.
So what I want to do right now is I kind of want to spend some time asking two questions. Where are we right now in market cycles? There's a lot going on. There's a lot of fear. There's a lot of panic. And then the next question is, should I be investing right now?
Mm-hmm.
So that's the first question. What's going on right now in our markets that's causing a lot of fear, a lot of panic, a lot of selling off? What's going on right now?
So, I mean, just starting, you have two sides, right? The equity markets and then the bond markets, or the fixed income markets. In a lot of bear markets, you usually have one or the other go way down, and usually it's not bonds. Bonds is supposed to be the safe money. What's happening this year, and I'll read this stat off, a 60-40 portfolio, so 60% stocks, 40% bonds, is down 21% in 2022, on pace to become the second worst year in history after 1931, which was, as you guys should know, the Great Depression. So we are in somewhat of an unprecedented time where the NASDAQ and the S&P, remember those big indexes that track a large amount of the U.S. market, are down 25 and 33% year to date. And then you have the bond market, which is supposed to be the safe money, down 20% as well. So investors right now are scrambling. They have nowhere to go. Safety, and really not losing money has become a premium. So that kind of sets the stage of where we're at. I mean, right now recording, it's, we're in the middle of October, so we're on quarter 3 now, or quarter 4, just finished quarter 3. So, and you look at all this stuff together, and we were just talking about this. Think about 2020 and the, end of 2020 into 2021, the absolute mania that was going on. Bitcoin at 67,000, NFTs selling for millions, all these meme stocks running up. There was a rush to invest money. And I would caution to say that is not really investing. That is more speculation. You buying something and hoping it goes up. But now we're at a time, and you go on TV, you go on Twitter, you go and you look at it. It is a brutal time to invest. Everyone says, "Oh, that's a terrible place to put your money." Cash. But the reality is, for investors, especially young investors, they absolutely should begin their investing journey if they are ready and able to, with an emergency fund set aside, and they have the active income to support that. Because starting now and starting in downturns only improves. Like, I was looking at a chart. If you invested in a 20% downturn, average 20% downturn, for 3 months when it hit. So that was before. So remember, a lot of depressions or in recessions go lower than 20 or 25%. They go 30, 40, 50%. But even if you started investing at 20%, 25% down, in 3 to 5 years, the 3 year return on average was 80%, and the 5 year return was over 200%. And I'll find the chart and send that to you, whatever. But like the reality is, if you invest in these times and have a long term view, you really can't f it up. And excuse my language, but you really can't.
we'll we'll have him chop that out. We'll have him
Yeah,
chop that out.
yeah,
Don't even worry about that. Don't even worry about it. But yeah, man. So you mentioned about, okay. So we're in a downturn where, there's a lot of fear in the market. And one of the things that I wanted to bring up was, one, there's a tweet from Wall Street Trapper, big
hmm
financial educator, influencer in the space. And he said, if you had been investing since 1982, you would have experienced 6 recessions, 5 bear markets, a financial crisis, and a global pandemic, but you'd still be worth $6.9 million.
yep,
Right, and that's just, I think that just kind of highlights the importance of getting in and staying in. Because if you look at a chart of the S&P, and we've already covered this, but the S&P is the Standard and Poor's 500, the 500 best companies in the United States.
yep,
And you look at it, like, of course there's volatility, but over time, it's just growing,
yeah,
and it's going up, and it's going up, and it's going up. So let's talk about that real quick,
hmm
because I said a bunch of words that, you know are not
yeah,
necessarily common knowledge. So what is a recession and what is a bear market?
yeah.
Because that's a word that's being thrown around a lot right now on CNBC and Bloomberg. What is a recession and what is a bear market?
So a recession, a lot of people have different definitions. The standard typical definition is when GDP declines for more than 2 quarters,
Okay.
which we are already in. That has already happened.
Right. Even though the White House kind of tried to change the definition.
They're trying to change the definition on us, but
Right.
the GDP is gross domestic output, and so and that is a number that basically all the central banks get to show whether the economy is growing or shrinking. And when you look at it, and then a bear market just simply is when stocks are falling. On average, on a bear market is when stuff is going down. People are selling. Investor fear is high. That's what I would describe a bear market as. People are bearish on the market.
Okay.
Uh,
And there's a number figure on that. Is that 20%?
yeah,
Decline of 20%, right?
yeah, it's 20%, and then some people say when also, and I like this too as a great indicator when the yield curve inverts, meaning whether the short term yield is higher than the long term yield or vice versa. That is usually a huge indicator of recession because that means no one is, and in this case it was no one is buying the long term debt. Everyone is buying short term debt because it's yielding more than the long-term debt is. So it's inverted there, and that's a huge sign. We've already seen that multiple times, and in multiple countries across the world. So, for all intents and purposes, we are in a recession, and we are there. Typically, stocks bottom, and this is trader asset management. What people say is stocks bottom 2 to 3 months before a recession ends.
Mm.
And so for people that are saying, and there's a lot of people out there still saying like, oh, we're not in a recession, whatever. But you have to realize if that had happened, we would be seeing job losses, which we're not. We would see if the market is bottomed and we're not in a recession, then it should be up from here, which I don't think it's going to be either. So you have to be really careful about who you listen to in these times and just let the numbers, the simple numbers, speak for themselves rather than if you follow CNBC and Fox and all too much, they're going to convince you one which way or the other this is a terrible market or a great market. So you have to know what they're selling, know what everybody's selling, which is
Right.
harder said than done.
Yeah. And catching the bottom of a market is, that's impossible. Nobody can predict the market. Nobody can predict when there's a bottom, when you're at the all time highs. Nobody can really predict that. There's another word that's been thrown around, and we can talk about that briefly if you want to. Is Fed hikes, federal pivots on the interest rate.
Yeah.
How important are things like that to you when you're looking at whether or not you should be investing? Uh,
As
and,
a
and and what does all that even mean to you?
so one as a regular investor, it shouldn't matter. I mean, it matters in the grand scheme of the economy and all this, but it should not matter in your decision to actively invest over a long period of time. Because, all these things are going to change. We're going to look back 5 years from now, and everyone's going to be going, this was a great time to buy. Why didn't you buy? And then there's going to be these stories, and we saw them in 2020 and 2021 of everybody that had bought in during the crash or whatever, basically flaunting their wealth and everything. But the reality is they took a risk, and it's a calculated risk. You have to realize that. And that's what, new investors have to understand. You might see that $100, that $1,000 that you put in go down. And especially when you're aggressive and especially when you're young, you can afford to do that. Would I tell a 50 or 60-year-old to throw everything in right now? Hell, no. But as a 20 to 30 or even younger, investing, the process, you have to understand it's a long-term game and know that there's a risk. There's a risk it all might go to zero, right? Like,
There is
so
a risk that it all might go to get zero, but if the S&P and Fidelity and Vanguard and it all goes to zero, I think we got bigger problems
much
than
bigger
what
problem.
than what our investments did. You might as well have you about a couple thousand rounds of ammunition if you want to
And
feel safe
get
then.
it together, yeah.
Yeah, because then it's like things are pretty bad. So, and I
And then
remember,
to go quickly on the Fed, I, the Fed and interest rates. So the Fed is the Federal Reserve, which is the central bank of the United States. That is not. It's not technically. It's technically controlled by the U.S. government, but it's not owned by them. Or there's a lot of different actors involved inside all the Federal Reserve chairmen, and the whole situation is their job is to use monetary and fiscal policy to the goal is to keep inflation at 2% or around there. That's been their stated goal. Whereas right now, and they have different tools to do that. They can raise interest rates, they can lower interest rates. That's the pivot you're talking about. And right now, we are seeing inflation running rampant, absolutely insane. Costs are rising across the board, energy, food, almost it's averaged 8%, 9%, and it's coming above expectations. So, and this is the last, story I'll give. You go back to the 70s where we also had a really high inflation rate where, fuel prices, energy crisis, stuff's out the window. Basically, our money's being inflated away. So the purchasing power of every dollar goes down. So in the 70s, what they did is Volcker, the head of the Federal Reserve, raised rates to a he basically, if you raise rates so much, you crush the economy. So rates go up, asset prices go down. Because why? It's harder to get money. Rates go down, asset prices go up because it's easier to acquire capital. You
and what
can,
you're talking about right there is quantitative easing for those
yeah,
who are tapped into some of our other stuff where we, post those. That's if you hear any of the, investment gurus talk about quantitative easing or quantitative tightening. That's what Braden is mentioning right here.
as simply as that. Yeah,
So that's it. So what you had in 2020 was we were in a global pandemic, and honestly, things should have slowed down, but because of excessive quantitative easing, things sped up, and
yeah,
now they're trying to bring it back to where it should be.
yeah. And this is what we talked about. The if you started from March 2020 and all the massive gains that we saw after the COVID crash, which was only short. It was like a month or 2 weeks really, where it got really bad. All the gains that have been gained from that all the way through now where we're at right now have basically all but been erased. So we're right back, like the 8 trillion, or whatever that they have pumped in. It is, there's a reckoning that is coming for it regardless. So we're somewhat in the middle of that, and then you add an energy crisis, and then you add war, and then you add all these conflicting powers. It gets, and then add global shipping in there. It gets tough. It gets real, and that's where we're at. And so the economy is reflecting that.
Right. All right. So let's reel it back a little bit,
Yeah.
because
Went
our
into
look, because we could both do that. We could do that all night.
yeah.
But so our whole goal is to educate a younger version of ourselves,
Yeah.
right? The version of ourselves that's in college, and now those guys in college, guys and girls in college, are getting NIL money. They're just coming out of college, Lord willing, to have a job and they're earning. So with everything that we talked about, with quantitative tightening, quantitative easing,
Yeah.
you know, inflation, recession on the verge. You don't know when the recession is going to be over. You still say that they should be invested. Somebody that's earning money right now should be invested.
It's an incredible time to invest. It is
Oh,
absolutely a huge opportunity for young investors right now to start at a base where they can truly have a trajectory. And it's as simple as just putting a small portion, whether it's 10%, whether it's $100 every 2 weeks, whether it's whatever, putting that away and starting to build. I mean, you're going to look up in 10 years and go, oh, okay, what do I do with the money? And maybe 20 years you don't want to touch it, but that I absolutely when here's how you should look at this. When everybody is running away from something, whether it's whatever. Last year it was oil. In 2021, everyone was just saying Exxon is dead. Exxon, all these oil companies are gone. We don't need them. Renewable, renewable, renewable. And then last week, Exxon just hit an all-time high ever. And what does that tell you? When people are running away from something, it usually means you should look at it. And so that's what I see with this market. Everybody's running away. This is a beautiful time for young investors to start to build positions very, very simply, like we talked about. You don't need to be going and buying a bunch of different stocks or whatever. I would simply pick one or two indexes and one or two really strong stocks that you believe in, and maybe just keep it indexing until you have more capital and time. But I mean, incredible opportunity. I mean, what do you think?
nah, that's I'm glad you went there, because that's one of the things we wanted to talk about was about the fear and the greed index, right? We talked about that, and that reminds me of the Warren Buffett quote. The way you put it, the way he put it, he was be greedy when others are fearful, and be fearful when others are greedy. And if you look at what you talked about, 2020, everybody's rushing into stocks, they're rushing into crypto, they're rushing into NFTs. It would have been a perfect time to kind of be fearful, because we were at the all-time highs. Now, did we know that? Did you know that we were on all-time highs and we're probably about to jump into a recession? No, you couldn't have predicted that. But I mean, that was a pretty cool mantra to look at and to talk about. And so when I say the fear and greed index, and I'm gonna have Alex pull this up on the screen, but the fear and greed index is an indicator developed by CNN, and its whole job is to measure the level of greed in the market,
Mm-hmm.
and fear in the market. So it measures investor sentiment. And right now, there's fear in the market. There's fear in the market.
Yeah.
There's a lot of fear in the market. It's not extreme fear yet, according to the index, but like you said, you should when people are running away, you should be looking to look at it and try to
And
understand what the asset class is doing.
here's the deal though. It's so hard to really, because all of this is psychology, and that's what investing is. It's 10% choices and then 90% psychology. Because I can tell you to go invest whatever, or you can say, oh my gosh, it's all crashing, this is when I should put in. But what happens if it goes down another 25%? And you watch that and you're like, I thought this or that. And so that's why you really have to know your own risk and know and be prepared for it. No one
Right.
can tell you what you're going to feel when you lose money until you lose money.
Right.
And so
Absolutely.
that's going to be so crucial is we talk all this and whatever. It is a great time to invest. It really is. It's just you have to be prepared for the market to go sideways for a period of time. You have to
Yeah.
prepare to really ride the wave, and that's the difference between guys and girls that make it and people that don't is they get scared out of positions. You know?
Right. And so I'm glad you said that about the sideways market, but I kind of want to go back to something you said earlier when you were talking about, before you start investing, you should have an emergency fund.
Hmm.
And you should, and so when you start talking about losing money, the first thing I go to when I hear you say that, and then when I think about the fact that my portfolio's down a little bit, which if anybody's investing right now and they're telling you that they're not down, they're lying to you.
Yeah.
They're lying to you. There's absolutely no asset class that's not getting smacked right now.
Yeah.
So if they've been invested for a period of time, a long period of time, their whole portfolio might not be down, but they're taking some losses right now. So if they're telling you they're not, be a little bit wary. But the thing that I think about is, okay, I put this money in the market because I know I'm not gonna need it for 10 to 15 years.
Yeah.
And I think that's the whole psychology of the thing is that, if your fundamentals are right, it's just like sports, right? If your fundamentals are right, when things start breaking down around you, you trust your training, right? You trust what you know, and
Yeah.
you're already good because you've built your base of your emergency fund. You still have income coming in. You have the basics, right, of of personal finance, right? So you didn't just throw all of your money into crypto and now you're hurt. And that's kind of what we want to like get you to visualize. Like, you're not going to take a freshman in high school in the weight room and start teaching them how to hang snatch,
Yeah.
right? You're
No.
gonna teach them how to squat first and how to, you know, do a single leg squat and maybe do some basics, and then you're gonna start getting into the, to the advanced stuff. So that's one thing I really wanted you to point. I really wanted to point out that I really didn't want people to miss is that the basics and the fundamentals that you need to have before you start investing is an emergency fund of 6 to 12 months,
Yeah.
right? You need to build that. You probably should have some steady income, and we never know what happens with jobs. People lose jobs,
Sure.
but you want to have those basics and those fundamentals down before you start getting into the advanced stuff,
Hmm.
right? So, and the second thing you said that I kind of want you to talk about for a second is a sideways market. What do you mean when you say that? I know what you mean before our audience. What do you mean when you say a sideways market, and what type of effect would that have on like returns and the money and things like that?
Yeah. So there is a stat, and I use this with my clients and investors all the time. From 2000 and from the end of 2001, 2002 to 2013, the stock market returned absolutely zero. So it literally just went up and down, up and down, up and down, and literally traded flat before taking off on the bull run that we just came out of. So that is what trading sideways is where you're going to see a rally and then it's going to be, a protracted step down. You're going to see these different types of things and it's not always pretty. And so a sideways market draws more people out of positions because they're always going to go chase the returns wherever they're seeing them at once. And so that's where you have to be careful is what do you do in a sideways market? My view, and this is my personal view, I'm not giving financial advice. I would focus on building positions that you really want to hold in great companies, and then having cash flowing companies. So owning companies and owning indexes that pay you to own them. And I think that's a cheat and a hack to beating these sideways markets is when you can visualize this. Okay, what happens if the market does nothing for the next 10 years? I know that these 5 companies or these 2 indexes and 3 companies that I own are going to pay me every quarter in the form of a dividend usually, and they can be different. There's REITs and different ways to do it, but usually in the form of a dividend 4 times a year, quarterly. That then, depending on your situation, you really can just reinvest and buy more shares of the company, because we look at this personal finance realm and how to be financially free. It's to build your buckets of income. So that's what I would look at in a sideways market for sure. Just those type of really really great companies, and then building income producing positions. Because if you let dividends grow, a 2% yield in 10 years can be a 6, 7, 8% yield. And I'll take 8% on my money every year without having to lift a finger. So those are the type of stuff I look for.
Man, I think that's important. And one thing too that I like about sideways market, not like, but that I think about, just from my own philosophy, is if the market is low and then so we're at all time highs in 2020. If it goes low and then it's sideways for 10 years, that's 10 years enough for me to like accumulate
Yeah.
thousands, hundreds of thousands of shares
Yeah.
and build like a huge base. And so for the next bull run, I'm already positioned.
Mm-hmm.
So I think that's huge. I want to cover dividends, but we're gonna do that in another. Like you mentioned that I really want to talk dividend strategy because
I'm a dividend guy. I like my
you're a
dividend.
dividend. You built a dividend. You built a ETF, a
Yeah.
dividend structured ETF. So we're gonna talk about that. So, uh, man, I think that was good. I think that was good. Is there anything else that you wanted to cover as far as where we're at in the market? Should I be investing? Because we're gonna. There's more questions we're gonna get into.
Yeah.
But
I mean, and
on those, is there anything else you wanted to
I,
cover?
I would just say you have to set up a system. You have to go, okay, this is going to be how I'm going to invest, and you have to put your money. If you make yourself make a decision every time you're putting money in, it's going to get hard, and you're going to forget to do it, and you're not going to do it, and this and that.
It's gonna
You
be
have,
emotional.
exactly. You have to make it a bit. You have to treat it like a bill. I tell people that you treat it like a bill, and you know what? It's a bill that's going to pay you later on.
Yeah,
And that's part of you talk about all the time, paying yourself first. Paying yourself first. You have to pay yourself first. So that's what about I think emergency funds, and then consistent investing every 2 or 3 weeks, and not trying to time everything. You're gonna be thanking yourself that you did.
yeah. No, I agree with that. So I mean, I feel like based on what we talked about, some of the takeaways would be have the fundamentals down pat, have the emergency fund,
Yeah.
have the income, have the basics of your have a budget, have the basics of your personal finance down. You mentioned not chasing returns, right? So if we are sideways for the next 10 years, don't go chasing this or don't go chasing that. If you want to add to your portfolio and add to your philosophy, then you can add to it. But don't sell and chase here and chase here, because that's a surefire way to lose. And then pay yourself first. Have a system. A lot of these brokerages, I know because I have Fidelity and it does it. They let you set up automatic investments.
Yes.
So every paycheck, if you want to take 10%, 20%, and put it in the market, you can do it without thinking. So when he says systems, that's what he means. It
Yes.
it comes out like it's going straight to Uncle Sam, but it's going to you. So and then there's different vehicles that we can talk about, and we'll talk about those later. Company matches,
Yeah.
different benefits that way, and different tax advantage accounts. But right now, I think we just kind of wanted to be high level and talk about, should I be investing right now? What's going on in the market? I think we covered that, man. So I appreciate you, man, and I'll see you next time as we cover something else.
Yes, sir.